Have you ever wondered why some investors seem to always pick winning stocks while others struggle to break even? The secret often lies in understanding just a few key numbers on a company's financial statements. And one of the most important numbers, yet surprisingly simple, is called earnings per share, or EPS.
Hey, real quick, before we jump into the video, please take some time to read the full disclaimer on the screen.
By the end of this video, you'll not only know what EPS is, but you'll also understand how to use it to make smarter investment decisions. So, what exactly is EPS? Let's break it down. At its core, EPS tells you how much profit a company makes for each individual share of its stock. Think of it like slicing a pizza. The company's total profit is the whole pizza, and each share of stock is one slice. EPS tells you how big your slice of that pizza is. Simple, right? But here's the exciting part. This number can tell you a lot about whether a stock is undervalued, overvalued, or priced just right. EPS is calculated with a straightforward formula. EPS equals net profit, dividends on preferred stock, average outstanding shares. Let's make that even simpler. The company earns some money in a year. This is its net profit. Then it pays dividends to preferred shareholders, if it has any. Whatever is left over is the profit available for common shareholders. You then divide that by the total number of common shares out there. Boom. That's EPS. Now, you might be thinking, okay, that sounds simple, but why should I care about EPS? Well, this is where things get really interesting. EPS is one of the most widely used metrics by investors to evaluate a company's profitability. It gives you a sense of how much money you would earn per share if the company's profit was distributed to each share. The higher the EPS, generally, the more profitable the company is. But, and this is important, EPS doesn't tell the whole story. You also need to consider the company's growth, industry trends, and how much investors are willing to pay for each dollar of earnings. Here's a question for you. If two companies have the same EPS, but one has 10 million shares while the other has 100 million shares, which one would you say is more efficient at generating profit for its shareholders? Drop your answer in the comment section. I'm really curious to see what you think. EPS comes in different flavors too, and understanding these can make you a sharper investor. There's basic EPS and diluted EPS. Basic EPS is what we just talked about, the simple calculation based on existing shares. But companies can issue stock options, convertible bonds, or other securities that might become shares in the future. Diluted EPS accounts for these potential shares, giving you a more conservative view of how profits are spread out. Think of it like predicting what your pizza slice would be if more people suddenly joined the table. Would your slice shrink or stay the same? That's essentially the idea behind diluted EPS. Another fascinating thing about EPS is how it ties into value investing. If you're a beginner, value investing is all about finding stocks that are priced lower than what they're really worth. EPS helps here because it gives you a measure of profit relative to the stock's price. Investors often combine EPS with something called the price-to-earnings ratio, or PE ratio, to see if a stock is overvalued or undervalued. A higher EPS can mean a more profitable company, but if the stock price is extremely high, the PE ratio might be too steep for it to be a good value investment. Let's do a quick mental exercise. Suppose Company A has an EPS of $5 and its stock price is $100. Company B has an EPS of $2, but its stock price is only $20. Which one is cheaper relative to earnings? If you said Company B, you're thinking like a value investor. That's because the PE ratio, which is stock price divided by EPS, is lower for Company B, meaning you're paying less for each dollar of profit. Now, here's a tricky question. Do you think a company with a growing EPS is always a good investment? Think carefully before answering, because there's a twist. A growing EPS is generally a good sign. It means the company is making more profit per share over time. But sometimes EPS can grow because the company buys back its own shares, reducing the number of outstanding shares and artificially inflating EPS. So, it's important to dig deeper and understand why EPS is changing. Are profits truly growing? Or is the slice of pizza just getting bigger because there are fewer slices? Let me know your thoughts in the comments section. I'd love to read your perspective. Here's a pro tip. When looking at EPS, always compare it with the company's historical EPS and the industry average. This context is critical. A $3 EPS might look small on its own, but if it's growing steadily from $1 over 5 years and outpaces the industry average, it could indicate strong performance. By now you might be wondering, how often does EPS matter in the real world? The answer is all the time. Analysts use EPS to forecast a company's future performance. Investors use it to compare stocks, and even companies themselves use it to decide on dividends. And here's the secret. Mastering EPS early gives you an edge. You'll start spotting profitable companies and avoid overhyped ones that don't deliver real earnings. Before we go further, I have a quick favor to ask. If you're finding this video helpful and you want to see more content that makes investing simple, go ahead and like this video, subscribe to the channel, and share it with a friend who's starting their investing journey. It really helps us create more amazing content for beginners like you. Okay, let's talk about some common mistakes beginners make with EPS. First, comparing EPS across industries. Companies in tech might have low EPS but high growth potential, while utility companies might have high EPS but slow growth. Second, ignoring share buybacks, as I mentioned earlier. And third, looking at EPS in isolation. Always combine it with other metrics like PE ratio, debt levels, and revenue growth to get the full picture. Now, here's an interesting question for you. If you had $1,000 to invest and had to choose between a company with high EPS but slowing growth and another with lower EPS but fast-growing profits, which one would you pick? Think carefully and drop your answer in the comments section. I'll be checking to see how people are thinking like real investors. Let's make this concrete with a simple example. Suppose company X earns $10 million in a year, has no preferred dividends, and 2 million shares outstanding. The EPS would be EPS equals $10,000. 2,000 pounds equals $5 per share. Now imagine company X buys back 500,000 shares. The outstanding shares drop to 1.5 million. The new EPS becomes EPS equals $10,000. 1,500,000 TLS, 6.67 per share. Notice how EPS went up, even though the company didn't earn more money? That's why understanding share count changes is crucial. Another thing to consider is trailing EPS versus forward EPS. Trailing EPS looks at past earnings, while forward EPS estimates future earnings. Both are important. Trailing EPS shows historical performance, while forward EPS helps you anticipate whether the company's profits might grow or shrink. A smart investor looks at both and makes a judgment based on trends, not just single numbers. So, why do we care so much about EPS in value investing? Because EPS is a fundamental building block of stock valuation. Think of it as a compass that guides you through the jungle of stock prices. High growing EPS is a signal of financial strength. Declining EPS may be a red flag, prompting further investigation. And here's a bonus tip. Don't get intimidated by decimals. If a stock has an EPS of $0.78, that's fine. Every fraction counts. Over time, these numbers compound, and understanding them early sets you on a path to smarter investing decisions. Let's end with this thought-provoking question. If you could pick one metric to focus on as a beginner investor, EPS, revenue growth, or debt levels, which one would you pick and why? Drop your answer in the comments. I'm really curious to see how your investing mindset works. EPS might sound like a simple number, but it's a powerful tool. It tells you how profitable a company is per share, helps you compare stocks, and guides your value investing decisions. Combine it with PE ratios, industry comparisons, and growth trends, and suddenly, you have a roadmap to spotting hidden gems in the stock market. If you've enjoyed learning about EPS and want more easy-to-understand investing tips that make complex finance simple, don't forget to like this video, subscribe, and share it with someone who's starting their investing journey. Mastering EPS is your first step toward becoming a confident investor, and trust me, it's a step worth taking.